Good morning to all. Let's continue with our discussion on portfolio management today. In our previous session, we have discussed a lot on different concepts and formulas. So today we are going to do some more practice on the questions just to see and firm up our understanding on the previous concepts. So let's start with question number 8, students. Good morning, Shailesh. Following are the risk and return estimates for two stocks, stock A and stock B. They have given us two stocks, and whatever is the expected return they have given us along with their betas. Okay. Then specific SD of the expected return. Now, students, this specific SD, which means specific standard deviation of expected return, would mean that they are trying to give us the residual variance, the residual risk, I mean. Why? Because this is very specific to the company that is mentioned. It's not generic. Correct? Then they have also given us the market index has a standard deviation of 25%, which is fine. And the risk-free rate on treasury bills is 6%. So they have also given us the market standard deviation and risk-free rate. Okay, which is fine. Now they're asking us to calculate the standard deviation of the expected returns of A and B. Now they're asking us to calculate the standard deviation of the expected returns of A and B. Now some of you might be thinking that they have already given one standard deviation of expected return, but students, please note this is a specific standard deviation, correct? So we have to arrive at the overall standard deviation, which is the overall risk. Now while doing that, there were two approaches that we discussed yesterday. One was using the Markowitz portfolio theory, in which we will need the basically the different scenarios, let's say the historical data or futuristic data. The second approach was on the Sharpe's index model, in which he said that you relate everything to market using beta, and then you arrive at your total risk or total return. Good morning, Tanisha. Good morning, Shruti. So in this specific case, we will take use of Sharpe's index model because the fact pattern is according to that. So we know that total risk. Good morning, Kirti, Mansha. So we know that total risk is equal to systematic risk plus unsystematic risk. Correct, students? So this was given under Sharpe's index model or single index model, whichever you can say. So here we said that systematic risk is related to the market, and hence the systematic risk will be beta square standard deviation of market square, which is variance of market, plus unsystematic risk was standard deviation of residual value taking a square there. Okay. So let's calculate that for stock A first. So for stock A, yes. So for stock A, what is the beta? 0.8. Systematic risk 0.8 square and 25% square. Correct? This will give us the systematic risk, which is 400. Unsystematic risk is also given as 35 square, which will be 1225. Okay. Then total risk. Here we are denoting this as standard deviation of A, correct? Because it is stock A. So standard deviation of A will be square root of 400 plus 1225, which is 40.31 percentage. Good morning, Anumula. Viraj, good morning. So for stock A, the total risk will be 40.31 percentage. Now let's come to stock B. I hope this is easy. So the systematic risk for stock B will be beta, which is 1.2 square standard deviation of market square, and unsystematic risk will be 45, sorry, 45 square. And hence the total risk, which is standard deviation for B, will be square root of 1.2 square, 25% square plus 45 square, which is how much? 54.08%. Easy. Perfect, Tanisha. Yes. 40.311. Very nice. Mancha, I will take up your query after this question. Then second, suppose a portfolio is to be constructed with the proportions of 25, 40, and 35 in stock A, B, and treasury bills respectively. What would be the expected return? Standard deviation of the expected return of the portfolio. There are two things being asked. Now they have asked us to first of all calculate the individual security returns. Sorry, the risk return is given. They have asked us to calculate the individual security risks. Now they are telling us to form a portfolio, and for that portfolio, what will be the return and risk? So let's first form the portfolio. Yes, Tanisha, perfect. 50.54.08. Answer is correct. So expected return of portfolio is what? So 25% for 14 plus 40% we will invest in B, which gives us 18%, plus another 35% we will invest, which gives us only 6%. Correct? So this is just a simple weighted multiplication and then addition of the amounts. So hence we will get a return of 12.8 from the portfolio. Now, standard deviation or risk, we can say it's a total risk actually. Again, we can say for total risk, what we need to do, we first need to take the systematic risk and add in that unsystematic risk. So for systematic risk, we first need to calculate portfolio beta. Correct? Because that portfolio beta, we will take the weighted average and multiply it with the standard deviation of the market. So 25%, 40%, 35%. These are weights. This is stock A, B, and T bills, treasury bills. Now tell me students, beta I'm mentioning here, which is 0.8, 1.2. Now I want an answer from all of you. What would be the beta of a treasury bill? What beta should we take for a treasury bill? It's not given in the question. Can you all try this? Yes, Tanisha, 12.8 is correct. So what should I take beta for a treasury bill? Okay, Kirti is saying 1. Mancha is saying nil. Come on, students, please respond. I hope all of you are there with me till now. Tanisha is 0, Shruti 1, Anumala beta equals to 1 for market. But, but we need to understand whether treasury bill is a market. I think that's a very important point which Anumala has raised, that for market always beta is 1. Yes, I agree. But we need to consider whether treasury bill is a market. No. Treasury bill itself is a risk-free return. And in our next topic, we will be studying about capital asset pricing model, in which we take risk-free return plus beta, RM minus RF. Correct? Shailesh is saying 0. Kusuma is saying 1. Okay, now let me break the suspense. It is actually 0. Because whatever market goes up or down, treasury bill will not change. The return on treasury bill will not change. It will always be fixed. It is always risk-free, which is what is given in the question as 6%. Okay. So it is not sensitive to the changes in the market. That's the underlying assumption. Okay. And that's the reality also. So we will just take the weighted beta here. But anyways, good attempt, students. I think somewhere, we link that since there is no movement, then beta should be 1, right? So I just wanted to point it out that if it is not related to the market changes, then beta will be 0. Okay. So weighted beta will be 0.68. Multiply and then sum. Okay. So the systematic risk of the portfolio will be 0.68 square multiplied by 25% square. Okay. And the non-systematic risk will be, again, I will put like this: A, B, and T bills. This is what ratio? 25%, 40%, and 35%. And lastly, the residual variance. Residual variance will be 30, is actually 35, 40. And now tell me, students, what should I take here as a residual variance? For treasury bills, the residual variance will be 0, students. Okay. Because there is no risk. If there is no risk, that means it is 0. So here what we will do, 25, 0.25 square, 35 square, 0.40 square, 40 square, and this will be 0. And let's take a summation here. So this comes as 400.56, and this comes as 289. Okay, then overall risk. $289 plus 400.56, which is equal to 26.26. Yes, Kusuma, Tanisha, Ambika. Yes, perfect. Ambika, good morning. Okay. I hope this is clear, students. So these are actually some of the questions that, will bring clarity as well as help us in forming our knowledge. Next question, students. Question number 9. Question number 9 is, the following data relate to A Limited's portfolio. So there is a portfolio of A Limited. What is that? XYZ Limited. Number of shares are given. Price per share is also given. And they have given us the beta. The CEO is of the opinion that the portfolio is carrying a very high risk as compared to the market risk, and hence interested to reduce the portfolio's systematic risk to 0.95. Treasury manager has suggested two mentioned alternatives as below. Okay. One is dispose of a part of his existing portfolio to acquire risk-free securities. That will help you in reducing your risk because you are disposing of risky securities and acquiring risk-free securities, right? Take appropriate position on Nifty futures currently trading at 8250, and each Nifty points multiplier is 210. So students, we will cover actually this specific part while we will be doing our derivatives part, right? But this is not that difficult to understand in the context of this question. We will try to see it along with the solution as and when we are doing. You're required to interpret the opinion of CEO whether it is correct or not. So first of all, what is the opinion of CEO? CEO's opinion that the portfolio is carrying a very high risk should as compared to the market. So should we see that what is the overall portfolio beta? Then we will come across that, okay, if it is more than one, then the portfolio beta will be, then the portfolio is actually carrying a very high risk. Okay. Sorry. So yes, students, calculation of portfolio beta. Okay. So we will put shares of the company X, Y, and Z. Okay. Number of shares were how much? 6 lakhs, 8 lakhs, and 4 lakhs. Market price is how much? 1000, 1500, and 500. These are the market price per share. So the value will be number of shares into market price. Here it will be 6,000, 12,000, 8 into 15 is 12,000, and then 4, 5, 2,000. In totality, 20,000. Okay, so these values are in lakhs, correct? These values are in lakhs. Then percentage to total, that means the weights. So 60 on 20, 6,000 on 20,000 is 30%. This is 12 on 20 will be 60%. Then 2 on this will be 10%. Beta. Their respective betas are also given. 1.5, 1.3, and 1.7 weighted into beta, which is 0.45, 0.78, and lastly 0.17. So the total here will be 1.40. Yes, Tanisha, very nice. 30, 60, and 10. So can we say that since the portfolio beta is 1.4 and the market is definitely at 1, so it is higher risky? Yes. CEO's opinion is correct as the portfolio beta is at 1.4, which is higher than market, and hence portfolio is at higher risk. Second, calculate the existing systematic risk of the portfolio. Now, students, in this case, the for calculating the systematic risk, we need to know that what is the standard deviation of the market, which is definitely not there. And hence, we will say that the systematic risk of the portfolio itself is equal to the beta. Okay. Okay, students. So systematic risk is 1.4 again beta. Then, sorry, advise the value of risk-free securities to be acquired. Now they're asking us how much risk-free securities to be acquired. Sorry. So students, CEO said that we have to bring out our portfolio to a beta of 0.95. So required beta is what? 0.95, correct? And existing beta is 0.1.4, sorry, 1.40, right? So let the investment percentage in risk-free securities be P. Okay. Then 0.95 is equal to 0 into P plus 1.4, 1 minus P. Okay. For the revised reconstructed portfolio, can we say that 0.95 would be equal to 0 into P? Again, I am taking risk-free securities beta as 0. While calculating this, P is 32%. So it says that 32% of the portfolio value, that is 6,400 lakhs, correct? This is actually 32% on 20,000. So this amount has to be invested in risk-free risk-free securities. Okay, students? So Tanisha is asking, on what basis and calculation the CEO made out that the portfolio beta was higher than that of the market. So actually, see, I think the CEO would have also referred to the respective, securities beta and securities standard deviations also, right? I mean, and it's just a way of presenting. The way question is drafted is that they have given us some problem statement, right? And they are asking us to validate whether first that problem statement is correct or not, and then devise a solution to it. Okay, Tanisha? So he would have also done some kind of a portfolio weighted average beta. Okay. Then let's come to the fourth part. Advise the number of shares of each company to be disposed of. Now we have calculated the total percentage, correct, which is 32%. But to arrive at the number of shares, individual shares to be disposed of, this will be calculated how? Number of shares of each company to be disposed of. Again, company we will say X, Y, and Z. Percentage to total is how much? 30, 60, and 10. Proportionate amount out of the 6,400 will be. So 6,400 into 30%, which is 1920 lakhs. Correct. Then 3840 lakhs. Then simply 640 lakhs. So the market price per share will be 1,000, 1,500, and 500. That is what is given in the question, right? So this part is given in the question. This is what we have said, that overall this much has to be reduced. Hence the number of shares will be 1920 divided by 1,000, right? Which is 1.92. This will come in lakhs. So 1.92 lakhs shares of X Limited has to be sold. Then 2.56 lakhs of Y Limited shares has to be sold. And lastly, 1.28 lakhs of Z has to be sold. Yes, students. Now let's come to the next part. So E part, advise the position to be taken in Nifty futures and determine the number of Nifty contracts to be bought or sold. Now it is asking us that the out of the two alternatives, there was a second alternative in which we will take Nifty futures. Now, what is this exactly? I'll tell you. So students, please hear me carefully. Okay. No, Mancha. Okay. First of all, this is not a portfolio value of 6,400. So 6,400 we have allocated here for the reduction purposes. So we are saying out of the entire portfolio of 6,400 to be reduced, 1920 will be reduced from X, 3840 will be reduced from Y, and 640 will be reduced from Z. Okay. That's why we have allocated. Now students, please note, Nifty is actually a representation of the entire market. Correct? Similarly, Sensex also for that matter. Nifty is for NSE, National Stock Exchange. Sensex is for BSE, which is Bombay Stock Exchange. Correct? So these indexes represent the entire market. Now, what people do is, since they have the entire holding, right, they will take a position. For example, we are already holding investments. Correct? We are already holding investments. That means we are facing a downside risk. We are having a downside risk because upside, whatever it will be a gain to us, right? But we are facing a downside risk. Now to cover for that downside risk, we have to take a position in Nifty futures so that whenever the market goes down, I will gain. Correct? And that will be happening only in one case when I sell Nifty. Sorry. Okay, students, when I sell Nifty, in that case, I will get, sorry, it's not sell Nifty exactly, but sell Nifty futures, right? So I will sell Nifty futures. So whenever the prices goes down, I will purchase that Nifty so that my purchase value is lower and sold value is higher. Okay. And I will get a benefit from that reduction. We will discuss actually these entire things of short position, long position. Actually, this is called as long position. This is called as short position. We will discuss all these things in our derivatives session. Okay. But as far as this question is concerned, we have to carry out a short in Nifty futures. Yes, students. Let's calculate. First of all, how many have to be taken in Nifty futures? Okay. So this was a understanding bit. Now let's come to the solution bit. Since the company is in long position in cash market. By cash market, we mean whatever we have invested in the stocks, right? Which is the spot market. It shall take short position. So short position means I'm selling today and I will purchase 3-4 months later on afterwards, right? So that is called a short position. Take short position in futures market. Number of Nifty contracts to be sold. 1.40 is our existing beta. 0.95 is where we want to go, right? So we have to cover up for the difference. What is the value? Okay, let me actually put it down so that it's clear in terms of the values. Okay. 1.40 minus 0.95 into 20,000 lakhs. This is the value of portfolio risk to be covered, correct? Because from 1.4, we have to bring it down to 0.95. And the value of Nifty future as of now is 8250 and the lot size is 210. So 210 is a multiple that they have said, but it's as good as a lot size. So we have to take 519 contracts to be short sold today. Shruti, I will explain in very detail once we cover the derivatives session. Okay, so maybe if not understand, you can all of you can park this point till that time because that is a half an hour discussion that we will do at the time of derivatives. Okay, I don't want to touch it now. I just want you guys to just have a preliminary understanding on this. Ambika is saying, sir, as there is a risk of fall in value of security, yes, then we must sell futures now with a high price. Yes, that's what Ambika is what the concept is. Okay, because the risk is downside risk. To cover up that risk, we have to short sell the either the security derivative or the Nifty derivative. In this case, since the question is asking us to do the Nifty derivative, and hence we are doing that for the Nifty futures, right? So this is done. Then the last part of the question, calculate the new systematic risk of the portfolio if the company has taken position in Nifty futures and there is a 2% rise in Nifty. Okay, now they are saying that now after they have taken 519 contracts that you have suggested as short sold, right? Now the Nifty has risen by 2%. You let us know what is the impact. Okay, we will be able to tell. If there is a rise in Nifty by 2%, what will happen? First of all, the current portfolio, we have two things now, right? In our portfolio, one is the exact portfolio that we had, which is 20,000 lakhs, which is untouched. And to balance that, we had short sold Nifty futures of 519 contracts. So there will be gain or loss here, and there will be gain or loss here also, right? So let's first talk about current portfolio. So current portfolio value was 20,000 lakhs, correct? Value of portfolio after 2% increase. Now, students, please note this 2% increase. What is the portfolio beta? Portfolio beta is 1.4. So, net, it will increase by 2.8%. Correct? So, 20,000 into 1 plus 2.8%. This gives us 20,560. I hope, student, this is clear. Since the Nifty has risen and we have short sold the Nifty futures, we will incur a loss on Nifty futures because we have sold it at a price of 8250. Now the price has become 8250 plus 2%. So we are at a loss. Okay, so let's arrive at the loss on Nifty futures. So which is 8250 into 2%. Okay. For 210 lot and 519 contracts. Okay, students. So the total loss here will be 179.83 lakhs. So this all we are doing in lakhs, rupees in lakhs. Okay. 179.83 lakhs. So the net value of portfolio after including Nifty loss. It will be how much? 2560 minus 179.83. So this is 2380.17. So this is the value of portfolio. Can we calculate what is the percentage change in portfolio value? 2380.17 minus 20,000 divided by 20,000 is equal to 1.90 percentage. Correct? So we are saying that after including the loss of Nifty, we are at 1.9 percentage, despite of the fact that the market has gone up by 2%. Percentage rise in Nifty is how much? 2%. So net, that means for every 2% increase, our portfolio will increase by 1.9%. So what is the beta now? Or new systematic risk? 1.9 divided by 2, which is 0.95. Okay, students, it was easy and simple. So students, I hope this is clear. I think there is one query from Tanisha. If we would have done 8250 into 2.8 into 210 into 519, since this way we would have considered the beta value as well. Please correct me. Yes. So Tanisha, I'll tell you. Okay. Now, please, everyone focus here. This is my portfolio. And there is a separate element of Nifty futures. Correct, students? So portfolio is having a beta of 1.40, which is fine. If what does this mean? First of all, what does this statement mean? If Nifty futures rise by 1%, portfolio will rise by 1.4%. If Nifty futures goes down by 1%, the portfolio will also go down by 1.40%. Okay. So it will go into the multiples. And let's say 2%, then it will also go up by 2.80 percentage, 1.4 into 2. This is the basic understanding. However, while you see this as collective operations, which is portfolio plus Nifty, okay, because as a company, I am having a long position here and I am having a short position here. So this is my collective portfolio, I can say, right? This is a new portfolio. With this, what we are trying to say is that it has become 0.95 only. The reason being, whatever 1.4 increase or decrease is there, it is offset by some amount of gain or loss on Nifty futures, which is driving our beta to 0.95. So hence here, Tanisha, we have not taken 2.8. We have taken 2% only because Nifty, while we see it as a standalone, instrument, if it is going up by 2%, the value loss or value gain will also be equivalent to 2%. Okay. Similarly, value of portfolio we have taken at 1.4 times of 2% because the beta of this portfolio is this much. But overall collective value is coming at 0.95. Okay, students. I hope this is clear. Now, there was a query from Mancha also. In the previous question, she said that explain the variance and covariance. I am actually explaining it again. Okay. Though we have covered it in our previous part. See, the variance and covariance. What was variance? X limited's deviation with X limited, right? In this, what we do, right? This is what we do. This, in case of covariance, X limited's variance in relation to Y limited. How X limited is changing, how Y limited is changing, and their collective variance, which is X minus X bar. Now here it will be Y minus Y bar divided by N. Okay, so let's say there are 10 observations. So X and Y, there are two series. So first you will calculate their mean, correct? First you calculate their mean and then the respective deviations and then the multiplication through this formula to arrive at covariance. Covariance is used in coefficient of correlation and hence the calculation of beta as well. Okay. Now let's move ahead. So we have completed our question number 8 and 9. Okay. Now let's come to question number 10. Before we come to question number 10, we will just cover a very simple and very basic concept of capital asset pricing model, which I think all of us are aware of. This is a very basic thing in which we say that return in a security is equal to risk-free rate of return plus beta market return minus risk-free rate of return. This is also called as the risk premium. Correct? This is called as CAPM. Now, the graphical representation of this, if you plot in a graph, that also we will cover once we will do the Sharps, Trenners, and Jensen's Alpha. So there are three portfolio evaluation techniques which we will cover today. The graphical representation of all this is called as security market line. So if in question somehow the security market line thing is given, so just think they're talking about CAPM, which is the capital asset pricing model. Okay. And see the theory here, it says that simply return is broken into two parts. One is the risk-free return, and second is the risk-adjusted return. Correct, students? Okay, so this is all about CAPM. We will cover other things from the questions itself. So Ambika is asking, how is it is long position in cash market? Ambika, because we are already holding the securities. So hence we have a long position in. So long position means we have purchased today and we are holding those securities which we can sell later on. Short position means we have sold today and we will be purchasing later on. Let's come to question number 10. Okay. So question number 10 says, assuming that two securities X and Y are correctly priced on security market line. So what they're saying is that you can apply the CAPM model, okay, because they're correctly priced. Hence, you can apply the CAPM. And the expected return from these two securities are 9.4% and 13.4%. The beta of these two securities are 0.8 and 1.3 respectively. Mr. A, an investment manager, states that the return on market index is 9%. You are required to determine whether the claim of Mr. A is right. If not, then what is the correct return on market index? So they are telling us to calculate the return from market, which is RM. So in this part, they're asking us to calculate RM, which is the return on market. So students, please note, since the question has also indicated already that they are correctly priced on security market line, then we should make use of the we should make use of capital asset pricing model using CAPM. We know that return of a security is equal to risk-free rate of return plus beta RM minus RF. Okay. Now, what is the first security for X? The return is how much? 9.4% is equal to RF plus beta is how much for first? 0.8. RM minus RF. Then for Y security, it is 13.4 RF plus. How much is this? 1.3. Correct, students? So here, what we have done, we have formed two equations. And ultimately, if you see, the question is asking us to calculate what? The question is asking us to calculate the RM. Okay, we have two equations, we have two variables, and to solve that from a simple mathematical operation, we can reduce, let's say, one equation from two, or we can collectively solve because we can take out the value of RF from here and put it in the second equation. Vice versa, we can do any operation. So if we solve equation 1 and 2, we come across that the risk-free rate of return is 3% and market return is 11%. What is Mr. A saying? He's saying that the market index is 9%. So hence, claim of Mr. A is incorrect as the market return is 11%. Any questions till now, students? I hope this is clear. Okay, so we have validated what an RM should be and what it is coming out to be. Then risk-free rate of return. The second part, it is asking us to calculate risk-free rate of return, which we have already calculated. So B part, risk-free rate of return will be equal to 3%. Okay. So this question just had a use of CAPM and some mathematical technique to arrive at and to validate the numbers. Let's move ahead, students. Question number 11. Perfect. Assuming that shares of ABC Limited and XYZ Limited are correctly priced according to the capital asset pricing model, the expected return from and beta of these shares are as follows. They've given us the expected return and betas. You're required to derive the security market line. So they're asking us to derive the security market line. So I will, okay, before going there, I hope all of you know the concept of a line because it is somewhere used. So hence it is important for me to bring it out. Students, when we talk about a line, okay, this is a line. This is a graph. Then this is x-axis, this is y-axis. This is independent variable, and this is called as dependent variable. Why dependent? Because the value of y is dependent on x. Okay. And then we say here that in this itself, uh, x and y are variables, a and b are constants. Correct? This all of you would have studied in your 11th 12th in your previous things, but I'm just recapping it so that it is, so this concept is actually this only, which is all the security market line and other things. Okay, so A was called as intercept and B was called as slope. I hope there is some thing left. So X was called as independent variable, Y dependent, A as intercept, and B as slope. Now, it was always told to us that this is a line. Okay. This is called as a line. Okay. So wherever it is cutting Y axis, it was called as intercept, right? And what is the degree of this line, right? Let's say this is was called as the slope. Correct? Correct, students? This is nothing new. I'm just recapping what you have already studied in your previous classes. Okay. Now, every line, and it was also told to us that every line follows this principle. Okay. Every line follows this principle. Now, I will relate the securities market line to this. Okay. While we will solve for this, we will come to this only. Now, let's come to the solution. Okay. So, we are at question number 11. Okay. So since the securities market line assumptions are holding true, let's calculate CAPM related. We will use CAPM to say that return of a security is equal to risk-free rate of return plus beta RM minus RF. Correct? So now they have given us two, right, shares. Return of A, B, and C is how much? We can put whatever values have been given to us. Risk-free rate of return is not there. Beta is how much? 1.2. RM minus RF is also not there. but we have the total 19.8. Okay. RXYZ is equal to, again, RF plus beta is 0.9, RM minus RF, which is equal to 17.1. So we have two equations. This is the first equation. This is the second equation. Can we solve both these equations to arrive at RM and RF? Yes, we can do that. Okay. RM and RF. Should I show one solution? I mean, how to arrive at, how to solve for these two equations, because it was there earlier also. So, okay, what we do is, let's say, deduct second from 1. Okay, deduct second from 1. So what we will do is, left hand side, and RHS, we will reduce it simply. 19.8 is equal to RF plus 1.2 RM minus RF. And here it is 17.1 is equal to RF plus 0.9 RM minus RF. Okay. So this will be 19.8 minus 17.1 comes as 2.7. RF minus RF will become 0, plus 1.2 minus 0.9, which is 0.3, RM minus RF. Correct? Now we can see from here that 2.7 is equal to 0.3 RM minus 0.3 RF. Correct? So can we say that, or else we can also say, sorry, we can actually take this value there, 2.7 divided by 0.3, which is equal to 9. Sorry. Yes. So RM is equal to 9 plus RF. This is what we have got from here. If we substitute this in equation 1, we will get the values. Okay, students. So if we substitute above relation in 1, we would get RM as 18% and risk-free rate of return as 9%. Hence, security market line is 9% plus beta. This is the equation. Okay, students. This is the security market line. Perfect, Tanisha. Yes. RM, Tanisha, is just check again. RF is 9%. Yes, perfect. Right. Okay, let's move ahead. So in a way, this is also line, right? This is dependent variable. This is intercept. This is independent variable. And this is slope. We will cover this in detail. Actually, slope is not only this, but divided by market beta. We will cover that. Okay. But just to give you a preliminary thought, this is how line is also seen here. Okay, students. So till now we have studied that how to analyze security portfolio, right? Both of them through risk, return, beta, right? All those things. Then SIM, Markowitz, portfolio theory, MPT, all those things we have studied. Okay. Now we also have to understand how to analyze, sorry, how to evaluate a portfolio performance. Sorry. Now we have different ways to analyze a portfolio performance because once the portfolio is formed, now there are some KPIs or there are some techniques to evaluate a portfolio. What are they? Yes, students. So please understand. I will start writing it. So there are three techniques. One is Sharpe's ratio. Okay. I'm putting second here and third I will put later on. Trenner's ratio. So what is the meaning of, or let's say, what is the Sharpe ratio denoting? Sharpe's ratio says that you calculate return of portfolio excess over risk-free return and divided by the SD of portfolio. Easy. Yes, students, this is easy. So what we are trying to say is that the excess return for 1 unit of risk. How much excess return your portfolio is giving for 1 unit of risk. Trenner's ratio, on the other hand, Trenner's ratio, on the other hand, says that you again take excess return, but in the base, you take beta of the portfolio. So this says that excess return for 1 unit of beta. Correct, students? So if it is higher Turner ratio means better the portfolio is. Higher Sharps ratio means better the portfolio is, because you will get higher return for the same level of risks being undertaken. Then next, Jensen's alpha. This is actually the third part. Okay. First, second, and now third. It says that actual return minus expected return. Okay, students. So if let's say you're getting an actual return, okay, let me just put, let's say, 2, 3 scenarios. Let's say we are getting actual return here, decision expected return. This, let's say, we have calculated using CAPM. Okay. The expected return we have calculated using CAPM. CAPM says that you should at least get 8%, and the market is actually giving you 10%. So what you will do? Okay, tell me, students, whether you will buy, sell, or do nothing. Tell me, students, quickly. If market is giving you 10%, your calculation says you should at least get 8%. What will you do? Whether you will buy that security from the market, whether you will sell that security, or whether you will do nothing for that security. So I think there are some mixed responses. Tanisha is saying invest or buy. Viraj is saying sell. Suraj is saying sell. Ambika is saying buy. Okay. So students, if the calculation is denoting you a lower number, but market is giving you a higher number, so you will buy that, correct? Because you will say that for the same level of investment, my calculation was saying that I should get 8%, but I'm getting 10%. So I should go buy that and take benefit of 10%. Okay. Now, for this case, what will your answer be? You will sell. Okay. Because your calculation is saying that you should at least get 10%. Market is only giving you 8%. Don't you think market is giving you a lesser amount? So you should exit from that investment. You should sell that. If both of them are 10 or 10, then hold or do nothing, basically, right? There is no need to sell. If you are already holding it, keep on holding it. If you are not having it, don't invest in it. Simple. Yes, students. So now, okay, let's do one thing before starting this concept, because this will take at least 20-25 minutes at a stretch to be discussed. So let's take a break of 10 minutes now. It's 8:14. Let's again reconvene at 8:24 and then take the discussions ahead. Thank you. Back, we were on this topic of uh, portfolio evaluation techniques, which is Sharpe's ratio, Turner ratio, and Jensen's alpha. So Suraj is saying, but sir, in second case, selling will lead to loss. No, Suraj, selling will not lead to loss in this case. We will exit from that. Simply, we will not want any kind of interest income or let's say return income on that kind of a share. Okay. So yes, students. Now, please pay attention. We have discussed these things in bits and pieces, but I'm just putting everything now here. Okay. So there are these two terminologies, capital market line and securities market line. Okay. So on this x-axis, in this case, there is a standard deviation. And in this case, there is beta. Okay. Y-axis is actually return here also and here also. Okay. And as we know that line is simply like this, correct? So line, there is no issue as such. The in the point where it intersects here is RF. Again, here it is also RF. Okay. And as we were discussing, these were the slopes. Now, students, please note that the standard deviation of market, let's say, is here. It crosses the line here. Okay, this is the point here where the standard deviation of market is actually there on the x-axis. So all the portfolios here are called as borrowing portfolios. Okay, and all the portfolios here are called as lending portfolios. So in a way, wherever our standard deviation of market touches that line, the left hand side and the right hand side are split, sorry, according to this. Sorry. So if you see, students, here the equation is RF plus RM minus RF standard deviation of market into standard deviation of that portfolio. This will give us the return. For this, the return is RF plus RM minus RF beta of market multiplied by beta of portfolio. Okay. So this is called as capital market line. So this equation is called as capital market line, and this equation is called as securities market line. Now, students, one more important point to note that Here, this is called as dependent variable. This was intercept, correct? Then this entire thing became slope, and this was independent variable, correct? Similarly, here it was dependent variable. This is intercept. This is slope, and this became independent variable. Now, students, what I'm trying to indicate all of you is, can you tell me what is this? We have studied it. Just let me know what is exactly this. Yes, students, please tell me, what do you think this slope represents? RM minus RF divided by standard deviation of market. What does this slope indicates, students? Manisha is saying beta, okay. Just now we have studied, students. What is this exactly? Just think and then answer, please. RM minus RF divided by standard deviation of market. For a moment, return of portfolio minus risk-free rate of return divided by standard deviation of portfolio. What is this? Just now we have studied, students. This is Sharpe's ratio. Correct? This is Sharpe's ratio. So the slope of yes, Ambika, Sharpe ratio. Very nice. Kusuma, yes, it is risk premium in the numerator, but you have to, if we are dividing by this 1 unit of risk, it becomes Sharpe ratio. Yes, Manisha, excess on return of or 1 unit of risk. So this slope of capital market line is Sharpe's ratio. I hope all of you are getting my point. Now, students, tell me, what is this looking like? RM minus RF divided by beta. What is this? This is again excess return, but on 1 unit of beta. Then what it will denote to? Perfect. Now I think I got the answers. Kusuma, Tanisha, Mansha, Anumala, Viraj. Yes. Perfect. All of you are right. Slope of securities market line is Trenner's ratio. See, the idea behind telling all of this thing to all of you is that sometimes in question, they will very categorically state that the slope of capital market line is this much. Then you have to interpret that they are talking about Sharpe's ratio for market. So this is a market Sharpe's ratio. And similarly for this is a market Trenner's ratio. Okay. Securities market line will be the Trenner's ratio for market because it is from the market perspective. Okay. Now, yes, students, let's come to question number 12. Mr. Abhishek is interested in investing 2 lakh for which he is considering following three alternatives. Invest 2 lakhs in mutual funds, X, invest 2 lakhs in mutual fund Y, invest 1,20,000 in X and 80,000 in Y. The average annual return earned by MFX and MFY is 15% and 14% respectively. Risk-free rate of return is 10% and market rate of return is 12%. They have given these two data points also. Covariance of returns of X, Y, and market portfolio are as follows. They have given us the covariance also. You're required to calculate the variance of return from MFX, MFY, and market return. So this is easy. We can calculate that. So students, if you see the matrix that they've given to us, MFX, MFX, the covariance, it simply means it is variance only. And simply this is also variance and this is also variance. For mix and mix, which is the market, 3.1 will be the variance. So variance of returns. So covariance between A and B was there was a separate formula, but covariance between A and A, what I'm trying to mention here is that covariance between A and A is actually the variance of A. Okay, so MFX is how much? 44.8. MFY is how much? 4.25 and mix is 3.1. Okay, students. Second part, portfolio return, beta, portfolio variance, and portfolio standard deviation. Now they're talking about this portfolio. Portfolio was what? 120 in X and 80 in Y. So first of all, can we calculate portfolio return? Yes. Individual returns multiplied by their weights. So we can just simply put MFX, MFY, 120 divided by 2 lakhs, 80 divided by 2 lakhs. So this is how much? 0.60, 0.40. These are the weights. So subpart A return will be 60% on 15% plus 40% on 14%. So this comes as 14.60 percentage. Correct, students? They have given us 15 and 14, right? So we have used that. Then beta. So first of all, students, we have been given covariance. Now from that covariance, we will need to calculate the beta. So what was the formula for beta, students? Beta using covariance between market and that stock divided by the variance of market. Correct? Or we have also studied that R12, then standard deviation of market into standard deviation of security, right? That was also one of the formula. But in this case, we are not using this formula because we are directly given covariance and variance of the market. Okay. So covariance of fund and market, MFX and market. First of all, MFX and market is this much, right? 3.37 divided by 3.1. So beta for X is equal to, and similarly beta for Y is equal to, for Y and market, it's actually 2.8. This is 0.903. So we have first of all arrived at the respective betas of both the securities, of both the portfolios. Then now portfolio beta will be 60% of X plus 40% of Y, which is 1.013. This is beta of portfolio. So we have calculated the return, we have calculated the beta. Now they're asking us to calculate the portfolio variance and standard deviation also. Now students, using the Markowitz portfolio theory, we know that this is a two security portfolio, X and Y, and the two securities portfolio, we use the formula of this portfolio variance would be weight of X square, standard deviation of X square, plus weight of Y square, standard deviation of Y square, plus 2 weight X, weight Y, covariance X and Y. Again, in this formula also, we are using the covariance bit, not the R bit, because there is another formula which is available for 2WX, WY, standard deviation X, standard deviation Y, RXY, correct? Instead of that, we have replaced it with covariance X and Y. Okay, students? Both the formulas are equally perfect. So this will be 0.60 square, and already this is 4.8 that is given. 0.40 square, and this is 4.25, which is also given. 2 into 0.60 into 0.40 into covariance between X and Y. X and Y is 4.30. So the variance comes as 4.472. Okay, students, I hope this is clear till now. Anything else that is not clear, please do let me know. Okay, we have calculated portfolio variance. Now the last part was for portfolio standard deviation. Square root of variance, simple. This is a one step answer, I think. 2.115. Now the next part, students, expected return, systematic risk and unsystematic risk. So they are asking us to calculate what is the expected return, systematic risk and unsystematic risk. Now, students, see, average annual return has been given to us. This is as good as the actual return. Now they are asking us to calculate the expected return. So can we make use of CAPM, capital asset pricing model, and calculate the expected return? Yes. So this is the third part. Expected return using CAPM. Mutual fund X will be 10% risk-free return. 1.087 is their beta. So mutual fund X will have a return of 12.17 percentage. Mutual fund Y, 10% plus the beta of Y was 0.903. 11.81 percentage. Correct. Similarly, portfolio will be 10% plus portfolio beta, students. Portfolio beta we have already calculated above. 1.013. Market return minus risk-free rate of return. So this comes as 12.03 percentage. Kusuma, can you please clarify? We don't have SD in formula means? Just elaborate your query once, Kusuma. I'm not able to understand. Okay. Then we have calculated the expected return. The second sub part of third part was systematic risk. Again, let's do for all three. Systematic risk, we understand that beta square, standard deviation of market square. This is called as systematic risk. Correct, students? Mutual funds of X, the systematic risk is 1.087 square and standard deviation of market square. What is the standard deviation of market? 3.1. That is given in that table, right? That was already variance. That was given 3.663. Mutual fund of Y. What is the beta here? 0.903 square into again 3.1. So this is 2.528. And students, please note that all these values are in variance form, not in SD form. Okay. Then lastly, portfolio. What is the portfolio beta? 1.013 square into 3.1. So this is 3.181. One more thing, students, I just want all of you to remember, please, that whenever we have to do this systematic risk plus unsystematic risk. So student, this is the equation, right? Whenever we have to do addition, or let's say we have to all, sometimes we can calculate unsystematic risk as total risk minus systematic risk, right? Even in such cases also, whenever there is a addition deletion involved in risk, always use variance and then take under root. Okay, always take variance and then take under root for arriving at the standard deviation. Will be equal to total risk minus systematic risk. Okay, students. So for mutual funds X, the total risk was how much? 4.80, which is the variance, minus systematic risk of 3.663, which is 1.137. Mutual fund Y will be 4.250 minus 2.528, 1.722. Portfolio is so this portfolio total risk, student, sorry, is coming from the number that we have calculated above. Okay, this one, the portfolio variance minus the systematic risk of portfolio. Now, students, we don't have systematic risk of portfolio. Yes, we have, sorry, 3.181. Correct? In the previous step itself, we have calculated that. So this becomes 1.291. So this is all again in the variance basis, right? Oh, okay. Kusuma, in variance of portfolio formula, at last we should have, yes, I'll tell you. So Kusuma, that's what I was explaining actually here, that see, this is okay. Now, from a separate relationship, we know that R of xy is equal to covariance of xy divided by standard deviation of x, standard deviation of y. This is from our previous session's knowledge, right? So, Rxy, standard deviation of x, standard deviation of y is equal to covariance of xy. Okay? We have eliminated this and introduced this in the above equation. Okay? I hope this is clear. So let's come to the next part of this question. Sharpe's ratio, Trenner's ratio, and alpha of X, Y, and portfolio mix. Can we calculate that? Yes. Sharps ratio. In case of mutual fund for X, it will be. So what is the return of mutual fund? 15%. Risk-free rate of return, 10%. Standard deviation of mutual fund X, under root 4.8. Correct? So this gives us 2.282. Mutual fund Y, this is 14% minus 10% divided by under root 4.250, which is actually 1.94. Then students, on the portfolio bit, what is our average portfolio return? That is 14.6 minus 10% divided by 2.115, which is what we have calculated the portfolio standard deviation, 2.175. Okay, students. Sharps ratio is very easy again to calculate. See, one more point, students, please note that we have not taken the CAPM return here. Okay. While calculating the Trenner's and Sharps ratio, some of you might think that, we have calculated the CAPM return also, but that is the expected return. That is not the actual return. The actual return is 15, 14, and 14.6. Similarly, in Trenner's ratio, mutual fund of X will be, so divided by the beta, right? 1.087 is beta, which is 4.60. Y will be 14% minus 10% divided by 0.903, which is 4.43. Okay, sorry. I think here it should have been added. Yes. Trenner's ratio 4.43. And for the portfolio, this will be 14.6 whole divided by portfolio beta, which is 1.0134. This is 4.54. And lastly, students, we have to calculate the alpha or Jensen's alpha. Sorry, which is the actual return minus expected return. Actual return is how much? 15%. Expected return is how much? This much. 2.83 percentage. Actual return is 14% minus 11.81%, 2.19%. Then for portfolio, 14.6% minus 12.03%. So that makes it up as 2.57 percentage. So students, now let us also note one more point. Let's see the real interpretation of Sharpe's ratio, Turner's ratio, and Jensen's alpha. If we say that mutual fund X, Y, and portfolio, within all three of them, which one have the best Sharpe's ratio? This will certainly be with mutual fund X, right? Because mutual fund X is giving you the highest excess return over and above risk-free rate of return on 1 unit of standard deviation of risk, correct? So with this Sharpe's ratio, X is the outcome. With Trenner's ratio, again the highest return, excess return over 1 unit of beta is from mutual fund X. And even on the Jensen's alpha, the highest absolute difference between actual return and expected return is coming from mutual fund X. So clearly, mutual fund X is the outlier in all the three evaluation techniques. Okay, students. Now let's come to next question. Question number 13. So there are two mutual funds, D mutual fund and K mutual fund, each having a close-ended equity scheme. Okay. Now they're talking about two mutual fund, but they are having a close-ended equity scheme, which is fine. NAV on 31st 12, 2014. This is again a very good question because it is a mix of mutual fund and portfolio. NAV as on 31st March 2014 of D and K, they would be giving. So for D, it is 70.71, 99% equity, and 1% cash. Okay. And here, 62.5, 96% equity, and 4% cash. Okay, students, this is understood. So what they have done is they've invested 96% of their funds into equity and 4% of the funds are kept as cash. So 62.5 can be broken up into two parts. 96% of 62.5 represents the equity portion. Balance represents the cash portion. Similarly for 70.71 also. Following is the other information. Sharp, Trenner, and standard deviation they have given for all three. There is no change in portfolios during the next month and the annual average cost. Please, students, note this is annual average cost. 3 per unit for the schemes of both the mutual funds. They are saying annually we take 3 per unit as a mutual fund cost. If the share market goes down by 5% within a month, calculate expected NPV after a month for the schemes of both the mutual funds. So they are saying that the share market goes down by 5% and hence you calculate the NAV after that. For calculation, consider 12 months in a year and ignore number of days for a particular month. Okay. Where are we standing? 31st December 2014. They are asking us to give them 31st January 2015. What is the value here? So we have to first see what is the beta of these two mutual funds, right? Sorry. Sorry. So let's calculate the beta. Sorry. Calculation of beta. Because till the time we don't have beta, we will not be able to see the impact of 5% increase or decrease on the mutual fund, right? Sorry. So D mutual fund is having a Sharpe ratio of 2. Sharpe's ratio is return on portfolio minus risk-free rate. And can we substitute in our Trenner's ratio? Because Trenner ratio is equal to RP minus RF divided by beta is equal to how much? 15. So 22.50 divided by beta is equal to 15. Correct? Is this true? So beta will be 22.50 divided by 15. 1.50. Correct? I hope this is understood. So we took RP minus RF, which is the excess return from Sharpe's ratio to arrive at the Trenner's ratio excess return and then arrive at beta. Similarly for K, mutual fund. Okay. For K mutual fund, 3.3 was equal to, I can say RK here instead of RP, RK minus RF divided by the standard deviation of 5. 16.5 RK minus RF. Correct? Trenner's ratio will be 15 is equal to, what is the Trenner ratio of K? 15, right? 15 is equal to RK minus RF divided by beta. So beta is equal to 16.50 divided by 15, which is 1.10. So D and K beta is 1.10 and for D it is 1.50. Okay, students, understood? Okay, students, let's move ahead then. Now, next step, once we have calculated the beta, now we also need to know that how will the overall value of portfolio coming out to be, right? So for that, we first need to understand breakup of portfolio of mutual funds, correct? So this is due, this is D and this is K, correct? So for D, the NAV is how much? 70.71 and this is 62.50. Percentage of equity is how much? Here it is 99% and here it is 96%. So equity element in NAV, cash element in NAV. Can we compute that? Yes. Because we can understand from this 99% on 70.71 is it's around 70. So 0.71 becomes the cash component. And similarly, here it is 60. So 2.50 becomes the cash component. Okay. Now, if the market goes down by 5%, so the beta equated market of going down by 5% will be the impact on the respective portfolios, correct? So what I'm trying to say is that 5% will have a 1.5 times impact on this, right? Similarly, for K, it will be 5% into 1.10. Okay, students? So equity component would go down by 5% into 1.5, which is 7.5%. And here it will be 5.5%. Perfect. Then let's come to NAV after 1 month. Equity component will be opening was how much? 70. It has gone down by 7.5%. Similarly, for this is for D, this is for K. K was how much opening? 60. It has gone down by 5.5%. Correct, students? So this comes as 64.75. Okay. And this comes as 56.70. Is this it, or should I need to do something else also, students? Now tell me, is this the final value I have to calculate, let's say NAV here after 1 month? So should I stop here or should I do some more things? Please do let me know, students. I have calculated basis the beta, whatever is the market going down, basis that I have calculated the revised equity component. But for calculating the overall NAV, is there something else I need to do? Yes or no? If yes, then what is that extra thing that we need to do? Cash component. Yes. Kusuma is saying cash component. Very nice. So we have to adjust for the cash component. So what is the cash component? What is the opening balance of cash? Where is the opening balance? Cash 0.71 and 2.5. Now students tell me, I am till here. Should I take a total here 64.75 plus 0.71 and 56.7 plus 2.5, or still I'm doing one less step that I should do? What should I do, students? Tell me. We are towards the end of calculating the NAV. Have yes, cost element. Very nice, Tanisha. Now, should I go and again read? It says that 3 per unit is the cost element. So what will I do? Cost element. Should I put 3? Should I put 3 or something else? It should be 3 by 12. This is the catch in the question. Why? Because 3 is the average annual cost. You are calculating the NAV for 1 month. So for 1 month, the cost is 0.75. No, wait. 0.25, sorry. Yes, 3 by 12. Tanisha, you are right. Perfect. Okay. So this has to be reduced to arrive at the overall NAV 64.75 plus 0.71 minus 0.25. So 65.21. No, Tanisha, we will not take it for 3 months. See, 3 is the annual cost. Divide by 12 will give us the per month cost, Tanisha. So there is no need for taking it for 3 months, Tanisha, okay? 65.21. Here it becomes 56.7 plus 2.5 minus 0.25 is equal to 58.95. So I think that is it. Let's go and check what was question was asking us to do. Calculate the expected NAV after a month that we have calculated. Hence the expected NAV after 1 month will be D and K. There are two different mutual funds, 65.21 and 58.95. Okay, students. Easy and simple. Any other questions, any other doubts, students, till now? Please do again ask. I am again telling. If there are some doubts uncleared, please do check on that. We will move on to the next question. The following are the details of three mutual funds of MFL. Okay, what are they? Average return, variance, and coefficient of determination. So they have given us the average returns. What are the variance on those average returns? And lastly, they have given us market also, students. Okay. So please do take this into account that they have given us market related average return and variance as well. Then they have given us the coefficient of determination. So students, this coefficient of determination is equal to R square. R we have studied, right? R is coefficient of correlation. Correct, students? So if you do the square of this, you will arrive at the coefficient of determination. Simple. So this is the reason why I've picked up this question is because of this coefficient of determination. Because this might be a new term to most of us. Okay. So, but there is no separate implication. It's actually R square, which is equal to the coefficient of determination. Now, the yield on 182 days treasury bill is 9% per annum. So the yield is 9% per annum. You are required to rank these funds as per the Sharpe's measure. What is the Sharpe's measure? Sharpe's measure is excess return over market, the excess return over risk-free rate of return divided by the standard deviation of that particular security or portfolio. Correct. Now, students, first of all, we need to calculate what is the standard deviation and beta, because in the next step, they're also asking us to calculate Trenner's ratio. So we have to also calculate beta as well as standard deviation. How we can calculate? Growth fund, balanced fund, regular fund, and market. These are four types of funds. Average return percentage is how much? 7, 6, 5, and 9. Okay. This is the average return. Variance is already given as 92.16, 54.76, 40.96, 57.76. These are the variances that are also given in the question. Can we calculate the standard deviation? Yes, this is easy. We have to just take a square root of these variances. This comes as 9.60, 7.40, 6.40, and 7.60. Okay, students? Easy. Then coefficient of determination will be, that is also given in the question, 0.3025, 0.6561, and 0.9604. In case of market, it's not given. Okay. Then Can we calculate the coefficient of correlation? Yes. We just have to take a square root of 0.3025. It comes as 0.55. 0.6561 square root comes as 0.81. 0.9604 square root, 0.9604 square root comes as 0.98. So coefficient of correlation is here. Now, if coefficient of correlation is here, can we calculate beta? What is beta? Beta is R, which is coefficient of correlation, divided by standard deviation of market multiplied by standard deviation of that particular security or portfolio. Correct, students? So, what is the standard deviation of growth fund? 9.6. Standard deviation of market? 7.6. Correlation coefficient? 0.55. Okay. So, R into standard deviation of uh, fund divided by standard deviation of market. So, this gives us 0.695. Next one. 7.4 divided by 7.6 into 0.81. So this gives us 0.789. Okay. Then lastly, 6.4 divided by 7.6 into 0.98. 0.825. This is also done. Now, the last step or the next step in this will be to calculate the Sharpe's ratio and Trenner's ratio, right? We have calculated beta, we have calculated standard deviation. All those things are in place now. So all the groundwork is complete. Now let's go to the solution. Calculation of Sharpe's ratio. Okay. Again, this is growth fund, this is balanced fund, and this is regular fund. Okay. For these three, we have to calculate Sharpe's ratio will be 7 is what their return is. Correct? What is the treasury bill risk-free rate of return is 9%. So students, please note already there is no excess return. There is a short return. Okay. Because in the market, the risk-free securities are trading at 9% or are yielding at 9%. However, our growth fund is giving only 7%. Though we will calculate the Sharpe's ratio, it will come out to be negative 0.208. Then B, 6 minus 9 divided by, again for B also the average return is 6%. It's even lesser than what T-bills are offering, divided by 7.40. Correct? So this comes as 0. Again, this will be a minus 0.405. Lastly, it is giving us 5% return, which is even lesser than the T-bill. Still, it is not excess, but lesser, but on a risk of 6.4. So hence it becomes minus 0.625. Now we have to give a ranking. Can we say that which is the first rank as per Sharpe's ratio, whether growth, balanced, or regular fund? Which fund has the first rank as per Sharpe's ratio? Come on, students. So, which fund has the highest ranking as per Sharpe's ratio? Students, growth, balanced, or regular? Please let us know quickly. Please answer, students. Okay, I think majority is that only. Tanisha, Mansha, Tanisha, yeah, thank you. Thank you for the responses. So, this is first, this is second, and this is third. Had it been positive, had it been positive, the highest positive would have been the first rank. Okay. Now, can we come to the. Yes, thank you, Viraj. Kusuma, please check once. If it is negative, then the lowest negative will be the highest. Okay. Then comes the Trenner's ratio. Trenner's ratio, again, the numerator will remain same. The denominator, it will be replaced by beta. What is the beta that we have calculated? 0.695. Let me pull down only. So it is negative 2.878. This is growth fund, balance fund, and regular fund. Now, balance fund, 6 minus 9 divided by 6 minus 9 divided by the beta, which is 0.789. So this is 3.80 minus 3.802. Okay, then 5 minus 9 divided by 0.825, which is equal to minus 4.84. Now, again, the same dilemma, which is the rank 1. Rank 1 is the lowest negative, as we have concluded in our previous part also. Yes, Mansha, again, G is the best. Yes, Tanisha, you're right. R, B, and G, when it would have been positive. Perfect, students. Yes. Now, the next part, compare the performance with the market. So they're asking us to compare performance with the market. Now, students, please note that the performance of market, we have to first calculate the Sharps and Trainer's ratio. Yes. For market, yes. So let's calculate that. Now, students, can anyone tell me what would be what is this number? I request everyone to please attempt this. This is very interesting. thing. For market, we are calculating the Sharps and Trenner's ratio. Yes, Shruti, G is the first. Perfect. Now, students, please concentrate here. I am asking for market. What is my Sharps and Trenner's ratio? First of all, please give me what is the Sharps ratio. It is very easy, students. This is very easy. Although this is a bit tricky, but this is very easy. Just think, what is the Sharps ratio for the market? Students, please note the facts that are given to you in the question. They have given you market return. They have given you risk-free rate of return. Please tell me what is the Sharps and Trenner's ratio for the market. I'm waiting for your responses, students. Please do attempt. Just think logically and put the numbers in the formula and then tell me. Very good, Tanisha. I will not reveal the answer, but Tanisha, you are right. Come on, students. Please attempt. See, it is very much evident from the simple looking of the data itself that is given in the question. I'll wait for more 30 seconds because I'm hoping a lot of answers to come. It's very easy, students. What will be the Sharps and Trenner's ratio for the market in this question? Yes, Shruti, you are also right. Perfect. Okay, let me put down. For market, what is the return from market? 9. What is the risk-free rate of return? 9. What is the standard deviation of market? 7.6. Correct? So this will be 0. Similarly, Trenner's ratio 9 minus 9 divided by what is the beta? Beta of market. Okay, now wonderful. Tell me what is the beta of market, students? We have not been given in the question what is beta of market. Beta of market is 1. Hence, this will also be 0. Okay. I hope this is clear. Now, the comparison between these two performances are that, see, the whatever we have calculated till now, everything is negative, correct, students? Hence, we can say that thus the performance of funds is very poor since all values are negative, whether it is Sharpe's ratio or Trenner's ratio, as compared to the market performance. Perfect. Shruti and Tanisha, 1 1 is beta. Yes, you're right. Great. So, students, with this, we have finished up this question number 14. Okay, I hope this is understood. So, these are some of the questions that are very good in terms of attempting it. Now, let me quickly come to one more, topic. I'm not getting into further questions now. I'm explaining one more topic, which was from the Markowitz portfolio theory again. Okay, let me just bring up. Till then, if any one of you have any other questions, please do post. Yes, students. So, Mancha, okay. See, we have not considered any standard deviation of T bills. See, these are two different things, Mancha. In the question, market is different and T bills is different. Okay, it is a coincidence that T bills are also operating at a market level, which is 99%. But it's not that these are same. Market is pure play market, but in this specific case, the market is also yielding 9%, which is equal to T bill, and hence the Sharpe ratio and Turner ratio is zero. But we have taken this as a separate, information. Okay. Now, students, please again, concentrate here. So, students, I discussed with all of you that there are two things in risk. One is systematic risk, and second was unsystematic risk. We said that beta is used in systematic risk. Correct. Now, one thing which I also want to cover up now is in case of unsystematic risk, we said that these are diversifiable risk. Correct. And it can be diversified by investing in more and more companies. The unsystematic risk will become zeroized. How we can do that? See, students, for two securities as per MPT, two securities portfolio as per MPT, we understand that this is the formula. Weight 1, standard deviation 1 square plus weight 2 weight 2 standard deviation 2 square plus 2 weight 1 weight 2 standard deviation 1 standard deviation 2 R1 2. Okay, students. Now please focus here, students. See, this was the formula that was discussed, right? This has a covariance substitution also that we can leave it separately as of now. If I say that two situations here, R is equal to +1, R is equal to -1. Okay, let's take two situations where R is equal to +1, because it might happen that this security 1 and security 2 are having a coefficient of correlation as +1. In that case, this will become till here because R12 as +1 I am ignoring. Yes, Mancha. Correct. So this will become R12 will become 1. So hence this is the formula. Now, if you read this formula, can I rewrite this as A plus B whole square, right? A square plus B square plus 2AB. This is the same thing. So what I'm trying to say is that if R is equal to plus 1, then simply you can take the weighted standard deviation multiplying by the weights and then take a summation and directly take a square of that. Okay. However, if you see, this will increase the risk, correct? This is actually increasing the risk. Depending on the weights, etc., it might go down from the individual securities, but directionally, it will be higher. Now, students, let's take an example of R is equal to -1. So when R is equal to -1, then sorry, can I rewrite this as weight 1 square, standard deviation 1 square, weight 2 square, standard deviation 2 square? Instead of plus, I am here writing as minus. Okay. -2, weight 1, weight 2, standard deviation 1, standard deviation 2. And I'm removing out R. Okay, because R is -1, I've already taken minus here. So can I again rewrite this as A minus B square, right? Which is W1 minus W2 standard deviation 2 square. This is A minus B square. Now, students, if you see, this will help you in a lower risk because these two are getting reduced. These two are getting subtracted so as to arrive at a lower risk. So the key point takeaway from here is that when R is equal to -1, then possibility of diversification is higher. Correct? Correct, students? Whenever R is equal to -1, then an overall risk will become lower. Okay, students? This is the key takeaway. Then lastly, in MPT, let's say we have lot of portfolios. We have too many portfolios, let's say thousands, lakhs of portfolios, right? Which all of them are having different risk and different return. Okay, so I'm plotting risk on x-axis and return on y-axis. Okay, students. So they have different returns and they have different risks. Now, if I plot all these into the risk and return x and y axis, then let's say something will fall here, something will fall here like that. Correct. Let's say n number of plottings has happened. So what Markowitz says that, portfolio theory says that there will be this kind of a arc that will be formed. Okay. And all the, which is the outer arc, right? Which is the outer arc. And these all will be the efficient portfolios. All the portfolios on this arc will be the efficient portfolios I'll explain what do they mean by efficient portfolio. See, efficient portfolio is something which is able to give you at the same level of risk either higher return or at the same level of return lower risk. Okay. What do we mean by efficient portfolio? Higher return, same risk, or same return, lower risk. So what is Markowitz is saying is for all these portfolios, these will be either giving you the highest return with the same level of risk, or these will be giving you the same level of return with the lowest risk, which is also true. If you see, if you compare this with this, right? This is, let's say, A and this is B. So B is giving you lower return and A is giving you higher return, but the level of risk is almost similar. Correct? I hope this is understood. Okay. Now, all the portfolios within this curve are called as non-efficient portfolios. Okay, students. And finally, if we draw a line touching this frontier right here, so wherever is the tangent is drawn, this is called as market. This is the market portfolio without any. So there is no further improvement possible in this. This is all. This is 100% optimized portfolio. Okay. Okay, students. So this is what I was trying to explain with the help of Markowitz theory, that all the portfolios on the efficient curve will be giving you the optimized return. And also, students, please note that this is the line that I have made here. This is called as the capital market line that we have already studied. Capital market line has risk and return, right? Correct. So this is as good as capital market line, and wherever the efficient portfolio curve touches the efficient, so the capital market line, that is called as a market portfolio. Okay, students. Any other doubts, please do ask me on this part as well as on the other part that we have covered today, students. Yes. So, Mansha, your question is when R is equal to 0, R is 0, yes. A square plus B square with weights. Yes, Mansha, that is correct. Yes, yes, Mansha, you're right. If R is equal to 0 in this case, right, then only this is left. Correct? Only this part of the equation is left. Perfect. Now, students, let us rewind what we have discussed till now in the entire portfolio. Okay, let's rewind that in another 5 minutes. Then we will wrap up our today's session. So, students, portfolio management, we discussed that it revolves around the discussion of how well a security is performing, how well a portfolio is performing. But we, we cannot leave these statements as open. We have to come up with some measurable amount, which in the form of risk and return, we have tried to captive it. Now, security return and security risk. Risk is standard deviation, mean is return. Return was possible basis two sets of data, historical as well as futuristic, similarly for return also. Then we said that for risks, there are different factors that contribute. Some of them are macro in nature, some of them are micro in nature. Micro are specific risks, which are unsystematic. Macro are systematic risks. Then we discussed about these components, variance, covariance, which we discussed today as well. Then we came to the portfolio. So the portfolio risk and portfolio return is very much similar, except to the fact that there are weights involved, that what is the contribution of that security in relation to the entire portfolio. The weighted return is called as the portfolio return. And for portfolio risk, there are two ways. One is the single index model. Second one is the Markowitz portfolio theory. Single index model link everything to market, whether it is your return, whether it is your risk, and take use of beta and eliminate the use of covariance as well as the R, which is the coefficient of correlation. However, Markowitz portfolio theory under risks had two different bifurcations, one for two securities, one for multiple securities. Two securities are helpful once we have R is equal to +1, R is equal to -1. That part we discussed just now. If R is equal to -1, highest level of diversification is possible because your risk will always be lesser. If R is equal to +1, you can just simply apply the formula of A plus B whole square. If R is something else, then you can just simply use this formula that is there. We can also think of different combinations by replacing R wherever it is mentioned by the covariance that we have discussed in a number of questions today, as well as in the previous session. So for more than two securities, we said that we have to follow the matrix approach. We don't have any other choice. Then we did certain questions around these. Right. Then let me quickly come to the single index model. Single index model, everything was bifurcated into, sorry, first the calculation of beta. Beta for we had two options. One is correlation method, second is regression method. Correlation method, this is the formula that we are using. We have used even today. Regression method, it's just a simple calculation. You just need to multiply the observations, summation of xy, then minus n x bar y bar divided by summation of y square minus n y bar square. Okay. This is the simple thing where we say that x is the stock and y is the market to arrive at the beta. Okay. Then today we started our discussion with CAPM, securities market line, and capital market line, and their linkages with the Sharpe's ratio and Trenner's ratio. Let me just quickly go to that one chart. Yeah, this one. Capital market line, securities market line, where we said that whatever is the definition of line is getting fulfilled with this. And we interpreted what is the intercept, what is the slope. The slope of capital market line, we always have to remember, is the market Sharpe's ratio. The slope of securities market line, we have to always remember it is the Trenner's ratio of market. Okay, students. So I think with this, uh, our discussion comes to an end today. Okay, we will see you in the next session now. Till then, please do take a good revision and do take, solve your practical problems even from the study material and ask any questions you have in the next session. Thank you. Have a good day ahead. Thank you. Technical team session over. Thank you.